AB InBev has agreed to sell its Australian operations to Asahi Group for an enterprise value of 16 billion Australian dollars. The Belgian company says it's still considering reviving an initial public offering of the Asian subsidiary. Joining us now is Bloomberg Intelligence's Duncan. Duncan, great to have you with us. What is your takeaway from what we've heard this morning?
Good morning. I think my key takeaway is that it means they're going to come back and do M&A in faster growth markets. You know, that Australian business is very high margin, but it's low growth. So they can get a good price and they can, push that cash to better use elsewhere, as well as reduce debt in the short term.
OK, and what better use will they use that cash for then, Duncan?
Well, the whole point, I think, of the Asian float was to try and do deals in places like China or Asia-Pacific West, as they called it, which are faster growth markets, younger population, and where they actually haven't got a particularly strong market share. So I think they like to be leader in all the emerging markets. So I assume that the IPO was for very much M&A in those regions, particularly China, Vietnam, India, places like that.
Under what conditions do you think this Asian IPO will go ahead?
Well, I suppose now you've sold one of the cash-generative businesses high margin, but you're leaving it with a much higher growth, higher potential margin business going forward as they do more investment. So I think when with the whole thing settled down, I'm not quite sure of the Hong Kong rules to be perfectly honest of when they can come back and how they price it. But I think at some point, once they've shown that they can reduce debt and they can do deals at attractive prices, then they can revive it at whatever price is right in the market at that particular time.